Welcome back, profitable traders, to another stock market analysis video. And if you're not yet profitable, make sure to follow me to get profitable. In this one, we're going to be doing a deep technical analysis dive into the semiconductor industry as a whole, specifically how to position ourselves ahead of July 9th, which is the key date every trader has marked on their calendar. It is the day that President Trump will be announcing the tariff rates for the entire globe. It will be a massive market moving event as it was in April. On top of that, we will be doing a short, medium, and long-term analysis on every key big semiconductor stock, such as SMH, which is the semiconductor ETF. It holds the largest semiconductor stocks, as well as NVDA, TSM, and Broadcom. Let's get right into it. Stay tuned. And to kick it off, we're going to be looking at the SMH ETF just to kind of gauge the general temperature of the industry as a whole before we look at individual stocks such as NVIDIA and the aforementioned. Looking at prior trends before we get into the forward-looking analysis, we can clearly tell that since late April to early May, the market has been in an absolute grind. It's broken out of the lows of April, which are the lows that we experienced because of the prior tariffing of the world. So we obviously can tell that the market prefers to be down here with heavy tariffs, but that is a later point, something to keep in mind. Anyways, as you could see, since late April, early May, the market has been in a rip upwards. It's been gapping up and going. All the pullbacks have been met with a bull demand. This is a strong bullish market. It's hard to say from a distance that you should be short this market, but looking into a little bit more of the nuance, you can kind of see what's been fueling this uptrend. And to be honest, what's been fueling this uptrend since the breakout, we got a little bit of natural growth. We broke out, and it's like, we had about 8% or 12% looks like of growth. And then that's when you kind of started getting a few problems. As you can tell over here, we have these equal highs with a moderate decline here in the middle. And what that shows us is there was actually double topping happening here. There's actually a bearish pattern happening here, but it got rejected because, as you can see at the neckline here, you got a massive long wick, which is all buyer support here. And the next few days we ripped upwards, showing that it squeezed the shorts out of here. People were shorting this market due to this pattern rejected, caught a lot of people offside and ripped to the upside. Again, after that short squeeze is over, it again has equal highs here. As you can see, it has equal highs, the same double topping pattern, except this one's even better. It has a doji in the middle. A doji is a hallmark of a double top. Whenever you see a doji candlestick with a moderate decline, kind of like we got over here, and then we get equal highs, after that, you have to be careful of a double top. Double top should be on your radar. Again, we come down to the neckline and it rejects. This one rejects in even a stronger way. I think this one was actually, if you look at financial Twitter, there's a lot of people at this time that was very bearish on the market, myself included. I was posting this chart, but I also did let you guys know when the pattern rejected on this day. I didn't leave you guys high and dry, but that's regardless. As you can see, once we get to the neckline, you get 2 days of wicking down here, which is basically 2 days of buying this zone before a massive gap up and go bigger than the prior one. Why? Because there was 2 days of buying instead of one. That means that the short squeeze is going to be even more intense. There's more accumulation, right? We get a boom, massive rip to the upside, and we closed last Thursday, which is the last closing or trading day of the week, at all-time highs. We closed at all-time highs. SMH has never closed at this price previously. So as you can tell from a distance, it looks like, wow, this market is squeezing shorts out. It's looking wonderful. Why should there be any worry? Well, the problem is, you have to ask yourself, why was there this sort of bearishness to begin with? There's not usually double topping that happens like this in an uptrend. Usually it's just like, let's just look at prior trends. Usually it just goes up, down. Get the arrow. Usually it's pretty nice. It just goes, up, down, just like a regular uptrend. Not really too funny or too much to look at there. But with this one, we were getting, some pretty weird price action. So that just kind of brings into the question, why might we be experiencing this? Well, it's true. We have been climbing the wall of worry. That is for sure. That's why you keep getting these bearish patterns. A lot of people are turning bearish on the market, but the bulls are ultimately prevailing. You have to ask yourself, when might this stop? Because of course, the market cannot be going up in perpetuity. Well, I actually believe that July 9th will be the day that the trend changes. Looking a little bit more into the nuance here, using the RSI as a tool, you can kind of see that the RSI is overbought. It is above the 70 line, and it's kind of forming a little bit of equal highs here, which, is not too concerned, or not very significant as of late. But if we do get a little bit of a pullback, which we would be due for, when you think about the fact that since this day right here on June 23rd, we have had only one red day. We've had one red day, only minus 1%. The rest of the days, this trend has been up. This trend has been up quite a bit. So the market is due for a pullback at some point, considering the fact that there is double topping, or not double topping, equal highs on the RSI. If we do get a pullback and it kind of starts to dwindle it down, that will open the door to a double top on the chart, on the RSI. And if you guys don't know, the RSI can actually show patterns. It can show very powerful patterns that you can trade off of. The RSI is a very powerful tool. Looking back in history, for the last time that we kind of got this double topping, with the neckline being the 70 line, which is even more confluence. If we just scroll back, let's see what we got. Okay, looks like right here in March 2024 is the last time we had this kind of equal high double topping here, or equal high RSI, with the neckline being right here at the 70 line. And it looks like, from that period, we were down quite a bit. This was the last day. It was down, 10% kind of in that first time, but it consolidated sideways and ended up dropping, a total of 16% before recovering. So, if we do see this pattern mature here, it could have some pretty bad implications. Also, this is something that I don't think a lot of people paid attention to, but look at the volume as we broke into all-time highs. Volume is not increasing. It's not like there's, market consensus here that the market truly believes that this market should be at all-time highs. Of course, yes, last Thursday was a short end trading session because of the upcoming holiday, but that's still, regardless, for a market to go up to all-time highs, we should see a burst of volume. This kind of shows that this break to all-time highs may just be a low volume floater. When the rest of the market, or the rest of volume, comes back into the market, the market may actually reject these prices, especially if we do have even topping on the RSI and whatnot. This almost has me saying that this might just be a little bit of froth in the market on low volume ahead of the holiday weekend, and it may not be a true break of all-time highs. Of course, time will tell, and July 9th is coming. Secondly, I do want to point out the fact that we did have a massive measured move from April that, ended up materializing into the breakout. I posted about this quite heavily on X, and the measured move is from, this top part here. This is kind of the neckline of the double bottom, and it was a higher low double bottom. Or you could, even if it's a range and you just want to, draw a triangle or a rectangle around this range, and just say this was just a whole range that the market was in. And when it broke out of the range is when, we got the sudden upburst, or the bullishness, whatever you want to call it. When we double this range, we end up at, $256, showing that the measured move from April lows has actually gone to completion, and we have surpassed it. A lot of it is due to there being a short squeeze, people turning bearish a little bit too early on this market. It seems like once we got above the measured move, We did start that double topping and it's simply just rejected and it's just squeezed shorts out. And when we observe the price action of what was going on above the measured move, you can see that it was the double topping that I pointed out earlier that had the 2 days of buyer support that completely rejected and ripped to all-time highs, it squeezed to all-time highs. Now you have to ask yourself, should I expect a massive second leg of this upwards move? Do I think there should be a pullback with a massive second leg here? That's possible, and time will tell if we do end up getting a smaller pullback that may materialize into a larger upwards move. I'll keep you guys updated on X. Follow me on X at Profitable Trader. But as of right now, there is really no technical reason for this market to go up as we got in April with all this accumulation and everything. It was obvious that sellers were exhausted, buyers were stepping back into the market, and there should be higher prices. That's not what we're getting here. The measured move from April has gone to completion, meaning there is no more technical reason for this market to go up. Now it's almost like you should be closing your long positions, and start either observing or looking for a short entry because you realize that this market, there's no more technical reason for the market to go up, especially when you can consider the fact that volume is declining overall. The RSI is not looking the strongest, already in overbought territory. I can't really go past that. When you start to kind of think like that, you kind of start to realize that this market may be a little bit overbought, a little bit overvalued, and there should be a pullback soon, especially with July 9th looming over our heads. And this brings me into my last point before we start looking at individual stocks is I kind of want to show you guys my own technical analysis, kind of something that I've been working on for the past few months and something that I've been trying to trade off of with SMH. So if you look at this period of consolidation here from it looks like September 2024 till February 2025, which is, I don't know, about what, 6 months there, you can kind of see that, or 5 6 months there, you kind of see that the market was extremely range bound. Market didn't make any significant moves in either direction, and we kind of got this box right here that the market was trading in, and it was only after we broke out of that box to the downside that we got a larger downside correction. And I want to show you guys, if you clone this box and you just kind of stack each box, and you just kind of stack each box on top of each other, you can kind of see that the market really found support in this due to this kind of box here. If I make 3 boxes, you'll be able to see that the market kind of measured 3 boxes down. The first time it broke downwards, it found support. At the second box, it kind of pulled up or pulled back before continuing down for the second leg. And you might say, wait, look, it broke out of the box right here. But this is pretty minor stuff. This is the only time I'll zoom in here on the hourly chart where we kind of focus on larger trends here. But I just want to show you guys, only time he broke down out of this box was kind of briefly, and it's not like it was sustained in any type of way. We broke down here, looks like we formed a bullish inverse head and shoulders, right shoulder, head, left shoulder here, and then we broke to the upside. Next time we did that was very briefly. We broke down below before continuing upwards, finding a lot of resistance at the top end of that zone before breaking out. And the market has been off to the races since then. But I want to show you guys that this box can also be replicated to the upside. So when I clone this box to the upside, you can clearly see that we're at the top end of this range here. Let's make it a little bit better here. You can kind of tell that we're at the top end of this range here, and that kind of we've seen how the market has been reacting off the zone. So if as we approach the top end of this range, I start to get a little bit worried. I start to kind of start looking for some sort of correction here, because as you can tell, these zones are very powerful. You can see we broke out, we retested that zone, and it ultimately fell through. We accumulated a lot over here before, or not accumulated. This is the double topping pattern that rejected and went through. Like, this is all happening at the top end of that zone. This is no coincidence, you guys. And I truly believe that we will be getting some sort of reaction off this market at this zone again. And I truly believe that we will be getting some sort of reaction off the top end of this zone. We just have to hope and wait that it's a bullish move. But I'm telling you, with July 9th looming over us, I truly cannot say with confidence that I can see this market breaking through the zone with confidence. I would be doing you guys a disservice. I would be doing the opposite of providing value to you guys. And I can't do that. I will tell you guys the truth. This market does not look poised to break through this zone. Not only just because, there's resistance here, but for all the technical reasons that I've told you guys before. The squeeze is done. Now what, you're gonna wait for, this market's not gonna squeeze up in perpetuity. That's not how things work. It will ultimately pull back. And when it pulls back, I believe that is going to be a catalyst driven pullback. And we know that catalyst driven pullbacks are the worst type of pullbacks. That's when the market just sells hand over fist. It's like people cannot close their position fast enough. People start buying puts like crazy. The market, goes down like what we saw. We've seen that before. It's not like I'm saying things that have never happened before, or have never, have zero chance of happening, when we just saw it a couple months ago in April. Moving on to the most beloved stock in the market, NVIDIA. As you can see, kind of looking at prior trends before getting into the more recent price action, we can see that since, similar to SMH, since late April to early May, you've broken out and you've had like this strong upwards move. Of course, there was some, there was a point of contention that happened around the same area as SMH, but this one had a more defined, clear channel that has since broken out, closing last Friday at all-time highs, closing on the RSI above 70 as well. I would like to just point out that, similar to SMH, this one has had a measured move that has gone to totality. If you take this range or double bottom, whatever you want to call it, and you put that on top, you can see that clearly the measured move was to $143, and it has since hit that zone. You can see that at that zone, you can see there was a lot of price action going on there, a lot of wicking, a lot of business happening here, a lot of, maybe you can call this chop, whatever. That just shows that this was a real zone and this measured move was real. As you guys can tell, I've kind of quickly been almost glazing over this channeling as nothing really significant, but truly, and whenever you see channeling the market, it really is significant, and I'll tell you why. Channeling opens up the door to something known as divergence, bearish divergence. If the channel is upwards, bullish divergence if the channel is facing downwards. But as you can see, this market was making higher highs over here, whereas the RSI was making lower lows. This was going on since May 15th till about June 20th, 23rd. So for about a month, this market was channeling the upwards direction. And I'll tell you why it was doing that. Not only was it approaching this zone, so what was going on here was there was this very bullish breakout here. And as we approached the measured move, the top end of the measured move, people started selling into that strength. So people are still buying, assuming that the trend is going to continue making higher lows and higher highs. But then there's also the technical traders sitting there selling into the strength, realizing that the measured move is going up to totality and there should be a reversal soon. The problem was, at this time, again, retail got very bearish, or there was a portion of retail that got very bearish, because of tariffs. I was in that group. I'm not going to act like I wasn't, except I was kind enough to tell you guys when the trend changed. Anyways, when retail turned very bearish, that means they were opening up short position and they were buying a lot of puts there. The problem is these puts were actually ill positioned, meaning the puts that they were opening up were too early. They were opening up these puts too early, meaning the bearishness hasn't actually happened yet. There is no reason to be bearish just yet, even though, yes, there's reason to be bearish looming. The real bearishness, there's no reason for it to happen yet. Markets still should head up, especially, in June 23rd is before July 9th. So why should the market be correcting for July 9th on June 23rd? That doesn't make sense. Might as well continue pushing higher until then. That's kind of what we're getting here. So it kind of rejected this bearish divergence that happened there. But you have to remember the event, the bearish event, has it's not like the bearish event didn't happen. It's not like President Trump, woke up July 9th and said, you know what, actually, we're not going to tariff anyone. That's not what happened. It was just that people were short too early. People changed their mind too early, and ultimately, you know, meant that they were ill positioned and opened them up to the possibility of being short squeezed out, which is exactly what we got. But now, with tariffs being less than a week away, it now makes sense to start positioning yourself accordingly for tariffs. And it seems like the market kind of is. When you draw a line from the previous all-time highs to the current price, of course, it's not like 100% exact, as you guys can tell, but it will do for the purposes of this video. If you draw a line from the previous all-time highs to the most recent price action, you can actually tell the market has been reacting, quite a bit off this zone. It broke out, tested the previous all-time highs, and has continued upwards. As you guys can see, the market did break through the previous all-time highs, pulled back, retested the zone, and continued upwards. But again, I just want to point out, this is all happening again on low volume. This is not the market consensus for the price of NVIDIA. You have to ask yourself, when will the rest of the market step in? When will the volume come back into the market? And when the volume does come back into the market, which direction will it most likely go? That question can be easily answered. When tariffs come on July 9th, which is the major market moving event, that's definitely when the volume will come back into the market. You can expect volume to come back into the market on July 9th. But we have previously seen what tariffs have done. We already know the answer to this question, which is very rare. We've never had an instance where, a president or any major market moving event such as this one has been almost showed its hand to us beforehand, where we already know that it's a sell event. We already know that's a sell event. So when the rest of the market does come back in, when the volume does come back into the market, and we do see, a break of previous all-time highs, you have to ask yourself, where will the bleeding stop? Yes, we know that the market is correctly priced with tariffs down there, but what's the technical analysis for it, right? Because if you're trading purely based on charts, you're not going to know that. Down here is when tariffs were enacted, and this is where the market is correctly priced with tariffs. If you're a true technical trader or trading purely based on technicals, you would have to look for the zone where the most buyers are accumulating and where the market has proven that buyers will step up. And this kind of leads me into the next point here of this whole move upwards since late April to early May has been kind of a thin structure event. And I'll kind of show you what I mean. Like over here, this was a gap, a lot of gapping going on here. It quickly moved to the zone, not a lot of liquidity. Yes, we channeled through the zone, but it was bearish channeling. It was bearish channeling, not the best type. And evidently, this was a short squeeze, squeezing all the people that were short over there out of this market in a low liquidity event. This is leaving a lot of gaps in the chart. A lot of gapping goes, and that means that there's not a lot of liquidity in the zone. These are thin structured, low liquidity zones. What a low liquidity zone basically means is it's a zone where there's not a lot of buyers there to defend that zone. For example, let's say this is purely hypothetical. This is just to explain what a thin structure retracement and how dangerous it can be. Let's say the market was to retrace all the way down to $130, right? If we get to 100 or not 130, let's say $125, right in this low liquidity zone. If the market was to retrace down to $125, and there's people sitting there asking themselves, wow, is this where NVIDIA is going to find a base? The answer is simply no, due to the fact that there's not enough buyers in this zone to step up and defend it. There's not enough people that have positioned themselves in this zone, that have bought this zone, so that when the market comes back down to retest that zone, there's not enough people there to buy in, to defend that zone, to base the price out there, to accumulate there as buyers. There's not enough people there, meaning that price is just going to continue to fall right through the zone. The people that bought here at 125 are just going to continue to sell. Or even if they buy, it's not going to do anything. It's not going to reverse any type of selling pressure, because there's just not enough people there. Market's going to continue to fall through that zone. Very, very dangerous. So when you see that this almost majority of this move up here, which let's just take percents here, this percent of low liquidity, 29%, nearly 30% low liquidity there. Then right here at all-time highs, another 11% minimum low liquidity. So it's like this is serious, right? Like if we are to get any type of retracement, any type of bearishness, any type of catalyst that would move price down, aka tariffs, if we were to get something that may push price down, you have to ask yourself, where will the bleeding stop? Where are the buyers going to step up to uh uh to defend the zone, especially if we break below the very frothy evaluation for NVIDIA at $153 or previous all-time high. If we break previous all-time high, honestly, it kind of opens a little bit of Pandora's box, right? We would break through, we would fill this low liquidity zone. All we have is bearish divergence here. It's not like there's real buying support here. This was just a short kind of squeeze event. These the people that long this zone, once the price kind of starts to retrace there, yes, it might have a small pullback because of the amount of buyers there. But ultimately, if we do get a tariff event, NVIDIA is not going to find a base at $140. That has never been where buyers have truly stepped up in a big way. For NVIDIA, it's always kind of just been like it's usually when we get to $140 on NVIDIA, it's usually like it's in passing into maybe all-time highs or maybe rejection. Like over here at 140, we rejecting, went down, but it's not where the market truly finds big buyers stepping up there. People are not big buyers of NVIDIA at $140. It's just a little bit too expensive, meaning that we will most likely fall through this zone. And we have a whole 30% right here to fall through. We have a decent amount to fall through right there of no buyers. There's nobody here to step up, right? That again leaves that 100 zone to kind of being bought up, similar to what we saw last time. So it's very possible that when the selling starts on this company or in this stock, that it will not stop. It will not stop, especially if it's a catalyst driven event. There's no big buyers to step up. This 1 month of channeling here it's not a bull flag. This is bearish divergence. These are people selling here that got squeezed out. That's not good. The market will come back down to find a base in the event of a catalyst driven event like tariffs, a major selling event. It will find a base at around this $100 zone, as we saw last time, as we've seen previously. That's where buyers stepped up, and that's truly where it makes the most sense. There's a lot of support here. This was a major resistance turn support. Market came, when the market did break out through there and it came down to retest, that's where the buyers stepped up. Boom, it went back up. Again, when it came back down to retest that zone, that's where the big buyers stepped up back up to all-time highs. You almost have to assume that maybe it may happen a third time. And so truly, to answer the question of where the bleeding may stop, I see the bleeding stopping really in this 110 to $80 zone, as we've seen last time. This is purely based on technicals, there. As we close out this section before analyzing TSM, I just want to ask a thought-provoking question for all the bulls out there, all the people that are truly longing this market, putting their money where their mouth is ahead of this tariff event. I want to ask, how much risk are you willing to take on? To me, it seems like this market is like, it's like almost like you lined up a bunch of dominoes, right? And all the dominoes are all this massive bull trend. It's like each candle is like a domino, a domino, a domino. You lined up all these dominoes, except these dominoes have very thin structure, right? It's like the wind is blowing on the dominoes or something. You have a force acting on the dominoes, and at any moment, at the person's choosing, at the environment's choosing, it can sell off. And when that sell-off happening, the cascade effect, the domino effect will happen. It seems like truly, if we are to get something like a minor, 5% pullback, it seems like that's enough to just start the cascade here. As we close out this segment before analyzing TSM, I just want to ask a quick thought-provoking question for all the bulls out there, the people out there that are truly longing this market ahead of next week. I want to ask, truly, how much risk as a buyer are you willing to take on? To me, this seems like buying up here is exit liquidity. It truly seems like at any moment, at any given time, if this market decides to pull back, there is a lot of thin structure below. It seems like even if we are to head up to, let's say, if you're a bull and you truly think that this market is headed up to maybe, let's say 170, 175, let's say you believe that there's, 10% upside still ahead, which is actually what some analysts believe, that NVIDIA may hit 175 this year, let's say that yes, we do hit 175, 10% up from where we are, but look at how much downside that we potentially have. 30 plus percent. Are you joking? Like this is not like you're buying in late April, early May with a bunch of with exhausted sellers, multiple weeks of selling behind you. It's not like that. You're buying into a market that has been trending upwards very, very aggressively in an unsustainable way, gap up and go, for multiple weeks here. So to me, it seems a little bit weird for somebody to risk gaining 10% on Nvidia options while you're risking potentially being wiped into oblivion if the market decides to sell this tariff event. Truly, there is no reason to be longing this market ahead of tariffs. You should, if anything, be sitting on the sidelines. And if you're a more brave investor, you should be positioning yourself accordingly, which is short. We already know this. We know that the market will sell tariffs. Anyways, I digress. Let's get into TSM. And then getting right into the analysis for TSM here, we can kind of see that we're getting a lot of the same thin structure as we were getting on NVIDIA, except this one I would argue has even more thin structure than we saw. This one, it seems like the majority, if not all of the move upwards was just just thin structure. I mean, recently ever since June 23rd, we've been on an uptrend with only, what is this, 2 days of downtrend before a big 4% day. And the downtrend was minor. It was 2 days that we lost less than 1%, almost you can almost consider that flat, and then just for the third day to be a massive plus almost 4% day, right? I mean, that just shows that this market cannot stop pushing up. It looks like buyers just will not stop slamming the table ahead of the tariff deadline here, right? But diving a little bit deeper into it, actually, before I get very, very deep into this analysis, I just want to kind of show you guys what a thin structure breakout is and kind of what happens. So we kind of got a lot of this thin structure breakout, over here from April 2024 up to July 2024 here on the charts. We can see this over here to me is pretty thin structure, didn't really get retraced all the way. Over here, pretty thin structure as well, did not really get traced all the way. And you can see that at some point it just hits a climax, right? And this is all-time highs, right? Similar situation to where we're in right now, right at all-time highs. Then all of a sudden the stock just gets dumped. And when it gets dumped, it's like there's no stopping this bleeding. There was no day over here for anyone long to get out. If you were caught off sides over here, you were caught off sides for the whole move down. I mean, there was no good time for you to exit. And that's just what we see happens here. When these low liquidity moves eventually do draw down and do move in the downwards direction, they move downwards in a very violent way. I mean, yes, you can sit here and say, oh, there's a catalyst. Yes, that doesn't matter. The market still moved in that way. There's a catalyst looming overhead now, right? It doesn't matter if it's catalyst driven or what. If it's just purely going off a technical analysis and what we see on the charts, when we see these low liquidity, thin structure breakouts, the retracement we get is intense. Kind of diving a little bit deeper into it over here, you can kind of see this is kind of what a normal uptrend should look like. For those of you that are kind of sitting there scratching your head thinking, wow, when I see gap up and go like I'm seeing recently the markets here, that looks like extremely bullish, that looks really strong. But I'm sitting here telling you guys it's the opposite. It's almost like I'm telling you guys don't believe what your eyes are seeing, but really I'm just telling you to look a little bit deeper into what your eyes are seeing. As I pull up the line tool here, or arrow tool, to kind of show you how a normal market should be moving upwards, right? How a normal market should be going up. So over here, you can see we had a very, we had a low down here, pretty, this looks like a pretty significant gap down that we had. This was, I think, due to the yen carry trade uncoiling in August 2024. But the recovery that we had from that time was very significant, and truly I would argue this is pretty thin structure. It looks like price was only in the same zone for 1, maybe 2 days before pretty heavy violent upswing days there, right? But then look at what happened here, and comparison to what we got over here, or what we're getting recently, right? over here, we hit a climax and then we came downwards, right? That's different than what we're getting recently over here, where it's like the market just kind of goes sideways, right? It's not like this market over here went sideways like we are today and then just continued going up almost like it can go up in perpetuity indefinitely without, like that doesn't make sense. The market truly did tested some of this thin structure down here, some of this low liquidity that we were getting, giving these buyers a chance to defend their zone, and even giving more buyers the chance to buy in at that zone. That's not what we got over here. What we got over here is an uptrend, stagnation for a little bit, violent uptrend, a little more stagnation, violent uptrend. That's different, right? And as we continue up this move, you can see why this move was so sustainable and why it actually went on for so long. And then eventually, when it did end, it took a while for it to end. This whole distribution thing up here took very long time for the stock to actually distribute, because there were so many people in the stock. There were so many buyers that were in the stock. It's not like, you know, one major selling event happens or one catalyst event happens and the whole market dumps. No, it's like people generally distributed, sold their stocks slowly over time here. Very different to what we got on the last thin structure breakout, where it seems like once buyers decided that buying time is over, it retraced the whole move. Look at this low. This low in August is an equal low to what the breakout zone we got in May of that original breakout, right? So it's like you can clearly see that once a thin structure move is done, it's done. There's nothing else supporting this market. It's like you built the house on toothpicks, right? Whereas this one is built by brick by brick. It went up slowly, right? That's kind of the difference here that I want to make abundantly clear to everyone. And just by nature of the stock market, the market will naturally go to where the most buyers and sellers are. That will kind of give explanation to why this whole move was able to get retraced, right? Because ultimately, the most buyers in this market previously were in this market. We're down here. That's why price ultimately came back down and visited that zone. That's why after this stock distributed up here, it came down and it visited this zone here, which is where the most buyers were accumulating and where it found support previously. It was the last previous major support zone for the stock. So that means if we were to get any type of pullback in this stock to the point where maybe a catalyst driven event like tariffs were to happen, and this stock was to pull back down, it's not going to find support anywhere up here. Truly, it's going to find support where it did last time, where the most buyers are in the market. That just makes the most sense. The market will gravitate towards where the most buyers and sellers are, which in this case is down here. There is not enough buyers and sellers in these little zones, in these little stagnation whatevers, to support the whole market. That's not true. Where's the volume at? Look at the volume right here. It's all down here. This whole move up has been on declining volume. You could draw an arrow pointed downwards for the trajectory of the volume, and that would hold true. You know what I mean? Like this move up here, to say the least, is unsustainable. And I would just like to point out very briefly before we move on to the next point, so we don't harp on thin structure for the whole video, is even down here, this right here, technically you could say was a thin structure zone, because price was only down here for one day. What happened? Price came all the way back down to visit that zone, and buyers accumulated there. Buyers accumulated here. That same thing can happen here. I would expect the same thing to happen, where we see a potential drawdown, to the point where all the buyers and the sellers have, previously defended their zone, which looks like a minus 40% move on TSM. But it's not crazy for me to sit here and say that when I give you so many reasons why this is so possible and truly a likely event to happen. I cannot put this outside the realm of possibilities for the stock market at this point in time. I'm not saying this is the only correct thesis. I'm just saying that it is something that I would weigh against any bullish thesis I may have. And if I'm a bear, I would see that I would use this potentially as even more reason or confirmation for my bearish stance, right? Now getting to the next point here of the RSI, we can take a look at it. It's in overbought territory, which is fine, but I want to draw your attention more to the structures that we're seeing here. And we're getting a very similar, even even highs as we're getting on SMH, which is something just to be careful about. Market symmetry, right? And when we get that type of market symmetry, it increases the significance of whatever's going on. So when you see an even high double, or not double topping as of yet, but even highs on the RSI with the neckline being the 70 overbought zone, it just kind of makes me, my ears perk up a little bit and say, okay, that's kind of interesting. Maybe, there may be some sort of drawdown here that may actually complete this double top, right? Not only that, but there seems on this chart that there may be an even larger double top forming here, with this being the first peak with a moderate decline here, and then the second peak being obviously this even high area over here. This would really be a top watch going into the next week. This is something that we would see play out over the next week if it will. So it's just being sure that you are being very careful, very vigilant, and the position that you're taking makes sense for the market conditions. You're not, throwing caution to the wind at any point, but you're also not, being super scared and saying, I'm not going to trade anything either, right? That's, scared money doesn't make money, right? But truly, this double topping here would be something that I would be watching very, very closely going into the next week, especially with tariffs looming overhead. All right, so getting right into the analysis for AVGO or Broadcom here. I think Broadcom is one of the most interesting stocks today because it was actually the only stock to hit an all-time high, semiconductor stock to hit an all-time high in June without it being due to earnings. Actually, if you pay a little bit of closer attention, you'll see that June 5th was the day that it actually reported earnings, but you can see the day prior is when it had the highest high. It actually made the all-time high the day before. With the after earnings there, that's why you had a gap down sell off the next day. So this actually allows us to use Broadcom as a bit of a benchmark against the other, or a benchmark for the semiconductor industry. So that kind of brings into the question, what would be ideal for bulls and what would be ideal for bears at this zone? So obviously, if you're a bull, you hit all-time highs, fine, you had a little pullback. But what would you like to see as a break of all-time highs? Because as you can see, we've broken all-time highs here. We broke, retested, we closed it above. It looks pretty good, just kind of at a glance. But again, I just want to bring out the point that volume is still declining here. It's not like this is not a market consensus move. I hate to be that guy, but it really isn't. This move is on declining volume, and also it is also on a diverging RSI, with the high on the RSI being June 5th, and then the new all-time high being formed, actually showing a little bit less buyer support as did previously. So those are kind of two major negatives going into the stock. And to do that, I love to expand out to the weekly chart. Kind of give us a little bit of a broader view while keeping any type of short-term trend a little bit still in there, kind of getting rid of that daily noise, right? Kind of getting rid of that little bit of that noise. And right off the bat here, you can clearly see that there's a pretty major gap right here on the weekly chart. If I were to measure it with the percent tool, just so we know how big it is, it seems to be about 5%, give or take. But still, pretty decent move. I would not mark that down as, something small that the market will leave behind. No, 5% of no liquidity is very significant. I truly believe that the market will have some sort of downturn pretty soon here to come down here and correct that, whether it be due to tariffs or some other event. I really do see this getting filled at some point soon before, continuing on for maybe a second leg move, right? You have to get rid of this liquidity before going on for a second leg. This is all happening right as the weekly RSI, is nearing 70. It's at 69.9 is what we closed at. Previously at the zone for the RSI, we had a pretty big top. Hopefully, that's not what we get. We get, a bullish upthrust, but ultimately it's for the market to decide. And all you can see here is say, because this weekly chart is not showing any real pattern or any type of or any real tradable action that you can sit here and confidently say, yes, I'm a buyer here. But I would like to point out that recently, in the past month, it seems like there's been a lot of these wicking going on, a lot of wicks going on. So we have a long wick here, long weekly wick here, a weekly wick here, and then we closed last week with an indecision candle right above all-time highs. That this could potentially turn into a hanging man candlestick pattern again. I'm not saying that is what's going to happen, but I'm just saying that has a very big potential, especially with all this wicking and all the and the tariff fears looming overhead. The next weekly candlestick, it really could be a red candlestick. That would not scare me, especially considering the fact that we've had no that the weekly trend has not flipped it down literally since these April lows. Since April 21st, the weekly trend has only been up. So, from I'd almost argue that the market is overdue for any type of pullback here. And the way that this stock works is once it starts pulling back, as we see on the daily, once it will start pulling back and it starts getting rid of some of these, gaps and thin liquidities, it will just continue to go down. It will just be a cascade effect. The buyers up here will start to sell. Once they start to sell, these buyers over here gets here, they start to sell, it just cascades down because there's no liquidity. Not only that, there's no real structure to hold up this market. Where will the market stop the bleeding? Where at this gap? Absolutely not. It will find, support down here at the lows, right? But also, I would like to say that this type of weekly gap is something that we're seeing across the board. Even on NVDA, if I were to pull it up, I also pull it up on TSM and SMH. The weekly gap, it is quite significant on each stock. It's kind of worrisome, I feel like. Sorry, bear through me as I fix the chart kind of live here. You can clearly see that this also has that same sort of weekly gap around the same zone, pretty far away. On TSM, it was 25% away. Let's see how far it is on NVIDIA. On NVIDIA, this one is by around 25% as well. If we look at TSM, this one also has that same weekly gap. We'll mark it and do a little measurement of how far away it is. Since this one is a red body candlestick, the close of it is actually down here. So it's a little bit, it's not right here. This would actually be the opening print, right? So when you measure this move, we'll see that it actually is around 25% as well. So that shows a lot of market symmetry. Even if we go to SMH just for laughs, even though we already know, this gap here is going to be just about 20% as well. So we're seeing that, on the weekly chart is showing potential for a minimum 20% decline. That's on the back of there just being no red days whatsoever in this market, or no red weeks whatsoever in this market. It seems this market every week since this SMH, really since mid-May, it has not gone down. We're going into the second week of July here. Again, basing is down here. The market is not going to stop bleeding right here. It's going to continue downwards to where all these buyers are accumulated. It's going to push through this zone, fall through this, maybe find support here, but I would expect it to fall through this zone here that I indicated prior in the video, accumulate there, and maybe we'll see some uptrend after that. When you see, the same thing across the board, which in this case is this weekly gap fill, which weekly gaps are very, very significant for price, more than a daily or an hourly gap up or anything like that, or gap. A weekly gap is usually gets filled. I think it's only a handful of times do markets leave weekly gaps behind like that before continuing a second leg in any meaningful way. But then also, kind of to close out the video here, or as we end this is going to be the last kind of section of the video here. We're going to be looking at the monthly chart for only about 2 stocks. We're not going to be doing SMH. We're only be looking at NVIDIA and TSM. These stocks are kind of like the greatest examples of this. We're getting kind of something that looks a little bit like, how do I say it? It looks a little bit like distribution, something called a Wyckoff distribution. As I clean up these charts here, I'll show you guys more clearly what I mean. So a Wyckoff distribution is when you get, it's a longer term distribution pattern It's not seen very, very often in markets, but it definitely does happen. It's in literature. It's when the market slowly distributes in three phases over a long period of time. So the monthly chart would be the perfect example of this happening. So it's when, you know, pretty even lows here. Even though yes, these are not, perfect lows. Of course, some of you guys may argue that, oh no, the second low broke below the last low, so it's actually not even lows. But truly, the market is not picture perfect, so this is as good and as close as it's gonna get. If you're looking for picture perfect markets, this is not one of them for sure. So with the Wyckoff distribution, you get, a distribution in three stages, each one slightly higher than the last. So the first stage is what's known as a BC, or a buyer's climax. It is where the buyers climax for the first time before a slow, a moderate downturn. Then it continues up into something called UT, which stands for up thrust, where we actually break through the previous highs. Then we draw down just a little bit like we did last time, and then you have the last one, which is called UTAD, which stands for up thrust after distribution. It is the final upward swing of the market before the larger correction pulls down or goes into effect. And usually in the literature, it will show that markets will or should break through this trend line, and continue lower. Again, I'm not 100% certain because I've never seen a Wyckoff distribution pattern, but I'm just saying this looks like if I'm just comparing the textbook to chart here, it looks like it may potentially be. But again, we need confirmation. We need this stock to come down more. So like, let's say tariffs happen and this stock does come down quite a bit, and revisit this $110 to $80 level. This would actually be a very, very key level, as it was last time, a very, very key level to see how the market reacts off that zone. If we do end up falling through the zone, then yes, this will be a confirmed Wyckoff distribution, and the market, will most likely be in recession time if that were to happen. If I'm being completely honest, that will not be good for the markets whatsoever. And we can also see the same sort of pattern on TSM over here. As I get rid of these drawings again, thank you for bearing with me, guys. You can clearly see that we have a BC, or sorry, we have a BC right here. We have a UT right here, and then a potential UTAD right here. But again, you could also say, well, wasn't this technically a UTAD? It came down and went over there. But I'd argue that this was actually part of a larger topping pattern, especially if you look on the 1-day chart. You'll kind of see that this was the distribution pattern that we were getting. So it was actually distributing at that same price zone, even though, yes, it was making a higher highs. That was still distribution, as we can tell in hindsight. So this is distribution right here. It came down. This one actually has very, very even lows. So for you perfectionists out there, this is right up your alley. You can clearly see BC. This would be UT. This would be UTAD, technically, if this one actually materializes as a Wyckoff distribution. And if we do get the tariffs, we should break through here. Again, that will be very, very likely that we'll be in a recession at that time. So I really hope that it does not play out just for the sake of the economy, for the sake of the American people, and honestly the globe as a whole. It would not be good for us to go into a recession. But again, that is just what I'm seeing on the charts. This is going to be the last point as I close out the video here. I kind of want to, just take the long-term view. Again, yes, this is more long-term, the Wyckoff distribution with this UT, or BC, UT, and UTAD. But also, I just want to give like my analysis, my thoughts. You guys are watching my video, so I'll give you my thoughts on what the semiconductor industry looks like as a whole over the long term, and kind of where it will most likely go. As long as, and I would like to say, as long as we continue to see CapEx grow, as long as we continue to see companies spending money like crazy, it's spending money on AI, buying NVDA GPUs and everything, the recent estimates, the projections for the industry as of right now will be true. And as many of you guys may know, the general consensus is that the semi industry will continue to turn a profit and will continue to innovate. But I would also like to point out the fact that, the weatherman is usually wrong, right? People's estimates for where the market will or should be at a certain time, or what should be happening at at a certain time are usually wrong. I mean, let's just think back to Tesla, the famous case of Tesla. I mean, in 2021, with all the hype around Tesla, everyone was saying, I mean, you can go back and look at videos from that time. I guarantee it, there were so many analysts saying that Tesla by 2025 will be delivering 1 million vehicles by Q3, Q2, whatever. Basically, they're saying in 2025, Tesla would be delivering 1,000 vehicles a quarter. And that's not even close to what we're seeing nowadays, right? I think Tesla maybe might deliver 300 or maybe 400,000, right? Not even close to what the estimates are saying. So really, take those estimates with a grain of salt. A lot of it is propaganda. A lot of it is just to move the markets one way or another in the short term, so banks can profit. If we continue to see like a higher for longer Fed, like if we see a Fed that just decides not to cut rates, this next meeting in July, which the market is not pricing in almost 100% certainty that the market will not be getting a rate cut in July, which is fine. But if we see a higher for longer Fed, that will make it harder for companies to easily spend money on AI development because the environment is kind of hard. The effective rate of Fed is so high. It's so hard to borrow money. It's hard for maybe even consumers to borrow money, right? It's not really good for business. Uh, so, and on top of that, if we continue to have tariffs and whatnot, we have tariffs, hindering the market. That again is just not. It's going to cause a little bit of slowdown. It's going to reduce consumer confidence. It's going to slow down spending, everything. So when we start seeing, the profits of Meta, of Google, of Microsoft, these stocks that or these companies that are spending, just hundreds of $billion collectively a year on, AI development on GPUs, whatever. Once we see those people slow down, that means that Nvidia's bottom line will start to slow down, will start to shrink. And once that happens, people will very, very quickly start selling Nvidia, thinking that the AI bubble is popped and it's everything's going downhill now, right? But that's not necessarily true either. Things kind of go in cycles. You know, this AI revolution that we just had starting in 2021 was really the last or the biggest revolution that we've had since 2007, which is the iPhone revolution, which is when the phones became very, very popular. Before that, I'd argue was the internet in 2000. So as you can see, like there's a lot of spacing between each development. I feel like the internet and the phone kind of internet and the iPhone kind of go hand in hand. Like, how are you going to use the internet without a phone, right? Like, it just kind of made sense. AI revolution was really the next big step. And from 2007 to 2022, that's about a 15-year gap in any type of technology gains. So, I'm not saying it's going to take 15 years before we see the next, AI jump, which maybe might be agentic AI or whatever they're working on, but it would definitely take, multiple years for them to get to that point, and also remember, keep in mind that we haven't even perfected the AI that we have right now, the generative AI, the ChatGPT, whatever. It's not perfect. So how can you really be sitting here betting on the next one when we haven't even perfected the first one? And it seems like you may be jumping the gun a little bit or just buying into the narrative a little bit too much. Just remember, things advance in stages and not all at once. Don't expect the next big AI development in the next year. That's really just unrealistic. We got the last one in 2022. We're still reaping the profits from it. Just let this one ride out. Um, be patient, and you'll make money in this market. You don't have to make money, in 2 seconds. You just have to be profitable. Um, really, that's all I have for you guys today. I really appreciate all you guys listening in. I know this was a bit of a longer video. I appreciate you guys watching to the end. If you enjoyed it, please leave a like. It really encourages me, and honestly will push the video out to even more people, grow the channel a little bit faster, as I have a very small channel. But I'm trying to grow. Be sure to follow me on X, at Profitable Trader. It's linked in the description below. You guys have an amazing week. Stay green, stay profitable out there. Peace out.